What is going on, traders? With every corner of YouTube talking about a market crash, to be fair, I haven't checked out each of these videos, so it could just be a thumbnail title game. I'm guilty of it myself. But with every corner of YouTube seemingly talking about a market crash, I'm going to tell you why I actually think the stock market can and probably will go absolutely insane, depending, very important caveat here, depending on what happens with these two factors that I'm about to discuss. Now, you really want to pay attention to this because it could affect your portfolio drastically in the short term. So let's talk about it. First and foremost thing is inflation data. Inflation is near a 40-year high, depending on what metrics you are looking at. And this is not a good sign, especially as the Fed continued to tell us that inflation was transitory. However, Papa J. Powell did retire that term last week as if it just never happened. Now, depending on when you're watching this, the next set of inflation data is set to be released on Friday, December 10th. That is tomorrow as of the time of this recording. And even though inflation is getting ridiculously high, what the market is looking for is slowing down inflation. And even though inflation is ridiculously high at the moment, what the market is paying attention to is whether we are seeing a potential slowdown in inflation. I think the market has already priced in that inflation is high. So what they are looking for are any surprises that inflation will actually continue higher than expected, or a slowdown in inflation, which would quell everyone's fears and would get them pumping money back into the stock market. How do I know this? Well, just take a look at the bond auction today. As you can see here, the demand for 30-year bonds went down, pushing the yields higher, because when nobody buys bonds, the yields keep going up until it entices enough investors to come back in. However, investors are laying off bonds for now because they are really waiting to see what happens with the inflation data on December 10th. If the inflation data is much better than expected, then you can imagine investors will stop investing in bonds or reduce their investing in bonds and will continue to pour that money into the stock market where the returns are better. If the inflation is worse than expected, then you could see investors pouring into bonds tomorrow and moving forward. The good news, though, is that this is all short term. If you look at the inflation forecast on the OECD, you could see that going into 2022, inflation is expected to slow down, not just in the United States, but worldwide as well. And I pulled up this article on kinoma.com, I guess, but it basically states that most of the agencies predict that the inflation will actually decrease in 2022 compared to 2021 if we're looking at CPI metrics or consumer price index metrics. Now, the second thing that we're going to be paying attention to is really a repercussion based off of the first thing that we discussed, which is the inflation data. So the inflation data will really inform what the Fed actually does. And for those of you that are in the know, the Fed's meeting is actually on December 15th. That is the official FOMC meeting. And Jerome Powell is a smart guy. He already telegraphed last week, and he wasn't even asked. The dude wasn't even asked. But he telegraphed last week that the Fed was looking at a faster taper in order to combat rising inflation. But him and Janet Yellen were basically at a Senate and a House committee. And they were really just talking about inflation, talking about the economy, talking about the potential Omicron virus and the effects that can have on the economy. He wasn't even asked about Fed policy, but he volunteered that information, saying that the Fed was looking at a faster taper. And for beginners, tapering just means the reducing of asset purchases per month that the Fed is doing in order to prop up the markets and the economy. So he already telegraphed that, so that information is priced in, and it doesn't come as a surprise when they announce it on December 15th. Now, if the inflation data is way, way, way worse than expected, then tapering is not the only thing that the Fed can do. They can also then commit to raising interest rates, which they basically have been putting off. They first said 2023, then they said, no, it's looking like 2022, but late 2022. Then they said summer of 2022. Now, if inflation data comes out on December 10th and it is way more violent than expected, and the Fed says, guess what, guys, we have no choice, our hands are tied, we now have to raise rates in addition to the faster taper, then the market can actually see a momentary crash in my view. And that would obviously put a damper on our potential Christmas rally. However, here's why not all hope is lost. Let's take a look at China. Now, China, the reason that I'm looking at the Chinese economy, obviously because it is inextricably tied to the US economy, and it is the closest in terms of size to the US economy. These are the top two economies in the world. China saw their inflation data came out before ours did, and they saw an easing of inflation, and their shares rose on the fact that their inflation has cooled. And I expect to see this in the US. If you're asking me if I was to make a binary bet on what I think will happen, I actually think that inflation data is going to be in line with what we expect. And I do expect the markets to actually rally in December. That is my expectation. That is my bet. We could talk about what stocks will rally harder than others, because I do think that there is a bigger opportunity in value/reopening stocks than there is in big tech at the moment. Big tech has had a monster 2020, a monster 2021, and I think that their growth compared to some of the beaten down value stocks is going to slow down compared to those stocks. So there's definitely going to be a bit of a rotation going on if we do see a rally, but I can easily see the S&P 500 make an all-time high in December, again, with the heavy caveat that inflation data is somewhat in line with what we expect, and the Fed does not divert from their policy of a faster taper by the rate that they described in the committee meetings last week. If the taper is going to be significantly faster than we even expect, and or if they talk about raising rates a lot sooner, then yes, we can expect a double top to form here on the indices. I'm looking at the SPY right now, and we could potentially retest, back the 450 levels or below on the S&P 500. Now, one thing I will leave you with is this indicator that Kramer uses. It's a paid indicator. I think it costs like $500 to $1,000 a year. It's called the S&P Short Range Oscillator. He loves using this. And I've back tested this. And if you guys remember, if you've been with this channel for a long time, I did a video in May 2020 talking about the short range oscillator. And I basically recreated it for free in Thinkorswim. Give you just about what you're looking for, right? And this indicator, like he stated in the video, is also, it seems to be really reliable at not predicting, but I guess showcasing what a possible market bottom is, right? So you see here the indicator how oversold it was during, this was the week of the stimulus. I was saying that the easiest way to make money in a recession is to buy blue chips when the prices are at an outlier, when they're basically anomalous. So getting Microsoft here at minus 30% discount, I mean, when are you ever going to see that again, right? So I was so comfortable buying Microsoft. I bought Amazon, I bought Tesla, I bought Nike, I bought Home Depot. We're not buying startups. We're not buying, small biopharmaceutical companies and loading in heavy on them. So I don't think we'll see, those companies. I do think the boat has been missed on those companies. I don't think we'll see them back at their crash lows here. All right, you get the point. Wow, man. I bought the dip back in 2020. And I'm getting depressed looking at some of those prices. But what I said in that video ended up being right. Not that I'm some type of oracle, but that we will likely never see those prices again on blue chip stocks. And the easiest way to make money is to actually buy heavy blue chip stocks. You don't have to reinvent the wheel. We don't have to look at, is Fubo the next XYZ? Is Jumia the next thing? Is QuantumScape the next thing? We don't even have to look at those stocks. Stick to blue chips on the dips and crashes and you will be fine. And yeah, lo and behold, we never ever saw those prices again on Tesla, Microsoft, Amazon, Apple, etc. But yeah, you certainly don't have to reinvent the wheel. Just stick to blue chips. Anyway, whole point being was in that video, I showcased how to recreate the short range oscillator that is actually a paid indicator. You could do so for free in Thinkorswim. And the thing to note here is if the inflation data is favorable and if the Fed really just sits on its hands, then this is potentially the short-term market bottom, at least as it relates to December. This is the short-term market bottom, and we will likely see a Santa rally. We rarely get a reading of -6 on the short-range oscillator, and we are now at that level. The last time, just for your reference, that we hit that -6 level was going all the way back to the correction of last year, almost same time last year, it was November 2020, and we actually hit minus 6.3 on the short range oscillator, and that ended up being the bottom. We did see a nice Christmas rally last year. So we hit that same -6 reading again on the price oscillator. By the way, go back and watch that video if you want a whole tutorial on how to set that up. I'm not going to waste time in this video because I don't want to stretch it out needlessly, but go back and watch that video. But yeah, so the conclusion is that, you know, if the CPI data is in line with what we expect and the Fed behaves in a way that they already telegraphed and there are no surprises, then I do think we are well on our way for a December rally. There's simply nowhere else to put your money. Investors clearly don't want bonds right now, as showcased in the poor bond auction today. It goes back to that acronym that I talked about called TINA. There is no alternative. There's nowhere else to put your money. But I'm under no illusion. I have a hedge open on the S&P 500 because I hold a lot of S&P 500 stocks. So I actually bought a put spread at the top at around the 467 range on the SPY. In case we do see a drop in the S&P 500, then I get to make some of my money back from the stocks that I hold, the heavy amounts of S&P 500 stocks that I own. And you can look at it as buying a small insurance policy on your stocks. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think the market is going to do. Let me know what stocks you are holding. And more importantly, let me know if you want a dip or not. There seems to be a varying opinion there. Subscribe to the channel. If you want access to all of our trades, link is in the description below. Would love to have you. Hit that notification bell. Stay safe out there, traders. Peace.